Okay, hello, folks. Welcome to Market Trends. I'm David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone. I'm going to just share a few disclosures with you in the chat, show you a few disclosures on the screen. Great to be with everyone. So, President Trump apparently about 5 to 10 minutes ago announced some reciprocal tariffs. I'm not sure exactly um, if they really do much in terms of people's expectations. Apparently, there was something about somehow targeting countries that have value-added taxes and things like that. But there's a quick little drop in the euro, and then kind of back to normal. So I think that's more or less what we've seen now. And this is what people mean when they talk about a wall of worry. So I'm going to get to that in a minute here. Let me just first also show you some standardized returns of some of the ETFs that we might be talking about. Remember, I did just give the disclosures out there, the prospectuses. So basically, I think the main message overall today is that there is massive fear in the market that is simply not panning out, and the other shoe isn't dropping. The scenario is not resolving in a bad direction. So let me just quickly now show you. Go to tradestation.com, and if you're on the main tradestation.com page, click up here on Insights. This will take you to the Market Insights blog. And then on this blog, wait a second, it's loading. There's an article, and that article has a rundown of the key things we're going to be talking about, some technical analysis and things we're going to be, oops, this one here. So I think there's a lot of evidence of this. There is significant evidence here of extreme negativity. And at the same time, there is, there's basically things are just not panning out in the bad direction. And we said it at the time. There was a flip in AAII sentiment about 3 to 4 weeks ago that was existential. It doesn't happen very often. The magnitude going from 1 week to insanely bearish to insanely bullish very quickly. It was a very big swing. Now we've actually dipped back today. The AAII data is the most negative again. I think it's over 50% bearish again on AAII. That is really interesting. We see some other stuff in consumer sentiment. We see some other stuff in the way earnings are coming out that also kind of create this sort of risk. I would say to things that being not as bad as people actually kind of fear. So that's really, and we're going to get to all that. So I'll just say very quickly what we are actually seeing today when we look through the different things is the first thing we're seeing is that we are seeing a shift back to growth stocks, away from value stocks, away from financials, away from industrials, away from airlines, and toward growth stocks, toward global stocks, toward Chinese stocks. And we've been talking about this. There's some really interesting breadth inside of the Nasdaq 100 I just noticed today. So we are seeing this kind of widening out overall. We are seeing all kinds of random companies doing well, like Cisco Systems or Coca-Cola or Pitney Bowes. And then the big names is kind of drifting around. We're seeing people finding new names. It's a lot of value turnarounds, a lot of stuff like that. So the thing is, people have been complaining about passive investing for a long time, indexing. People are just mindlessly buying indexes and stuff like that. Well, this is now something where maybe people are going to really start to look for other things, these turnaround names, like Coca-Cola, but also Intel, Crocs, MGM Resorts, Vertex Pharmaceuticals potentially. There's a lot of these different names, and we highlight some of them actually in the blog today. So let me just quickly jump over to the chart because as always, there's a few things I like more than charts on the award-winning TradeStation platform. And this is basically the chart that we have in the blog today. If you look at this, and if you go down here, you see the chart. So there's a few things here I think are very important. It is interesting. I actually forgot to add it to this other chart here, but this is an inside week. This was a week. This here was an entire week. 1, 2, 3, 4, 5. This huge swing from down here to up there. So we are inside of last week. We're in a bullish. Well, I don't know if it was a bullish week. But we're inside of it's an inside week that we now have inside of last week. So we did State of the Market on Monday, and we go through the overall index. And to me, the really key thing, there's a lot of key things about this chart that make it kind of, not, it's hard to see bearish things on the chart here. I have to just say, when you look at this, I mean, I always try to be objective, and I really look at this, and I see basically a support level here, a higher support level here, a higher support level here. So we have stair stepping toward highs that we basically held. That was an all-time high, went down, made support. All-time high, went down, held support. Then we have this other one. So these are weekly. We document it if you want to actually see in the blog post. We go through it and we do talk about it. So I think that's really important to realize. It's also interesting that the low on um, yesterday, what was the thing yesterday when the market dove? I'm trying to anyway. The market dropped and basically it made its low. That on CPI tomorrow. Yesterday CPI was hot. The low occurred in the second minute of trading. If you look at times like this, the low here occurred in the first minute of trading. This low occurred relatively early on the. So basically, what's happening is we're getting gaps down that last for less than an hour or two, and then movement to the upside on the intraday basis. We're not going to get into the intraday charts in this webinar, but I want to just mention that you can look on your own intraday charts if you want. So that's important. The 50-day moving average is kind of going nice and slowly higher. This is our moving average speed, and it shows this red line here, the 50-day moving average. But what's interesting to me is that if you look at this over time, you can see at other times that it often just kind of, there was another period here right around, wait a second. You know what? That's wrong. All right. It was basically back here. It was back here in April and March, where basically it just flatlined for a long time and then it extended. So basically, you can see the moving average really slowed down, but it was still rising ever so slightly. And so sometimes what happens in an uptrend is you just kind of hug the 50-day for a while and then you expand off of it. And then you hug it again, and you expand off of it. So I just want to point that out, that is something interesting here, where if we close above 6101 roughly, which would be basically last week's that high. It was 6101. Basically that was the high. It would basically, you can see this trend line. We're already pushing through it. Slanting trend lines have some importance, but they can also cause confusion. The really strong confirmation comes from horizontal levels, and that level is 6101. If we close above that, it might actually be a confirmation of a run to the upside, and it's for no good reason. And I think in some ways that is actually the most interesting thing about this. Well, actually, there are some reasons, but the thing is the fear is so high right now, and the market is not confirming to the downside. That tells you there's cash on the sidelines, and there's not leveraged long positions, complacent leveraged positions to get unwound. To me, that's one of the most important things to realize. The thing that really causes sell-offs is when there's a lot of people leveraged over their skis, and then they have to basically get margin calls and it liquidates. That's the big thing, and that is the opposite of what we're seeing right now. So it's just interesting that we've just weathered a lot of bad news, the CPI, the DeepSeek, the tariffs, all this stuff. And then we got some, maybe suggestions that things are going to get better in Ukraine and Russia, and Putin maybe going to be meeting in Saudi Arabia, something like that. But the thing that's interesting, though, is that, again, if that geopolitical risk goes away and Europe can kind of get out of this funk it's in, and the dollar is peaking, which I think we've been talking about for a while here, I think those things together create the potential for a shift away from American stocks toward global stocks, and it could last a few quarters. It doesn't mean that necessarily America is a bad economy or anything. What it means is that America, the United States, has led for a long time. Valuations are higher, and essentially, we have people. Everyone was talking about American exceptionalism and all that stuff. Usually, when you hear something get completely beaten to death, it means it's over. And in some ways, we were hearing American exceptionalism just continuously in the last few months. And then basically, now what are we seeing? We're basically seeing European stocks leading to the upside. You can actually jump over here to MT Main and go to key ETFs. I'm trying to see here. What do we have on the global? Oh, man, I need to add some different ETFs here. There are some other ones, but if you look at, there are global ETFs. I'll just tell you now that it is outperforming. We are seeing it. The Chinese things have been doing relatively well. The Europeans, the German ETF, you have to look them up yourself because I don't have them built in here yet. But they are out there. The DAX hitting an all-time high. The S&P is not. That tells you something. The DAX is basically the German Dow. So this is kind of what's coming together here. Now, as we look, let me just see here. There's a second trend line that in my view is pretty important we want to be aware of. Like I said, we had a trend line here. I didn't put it on the chart, but basically it's this trend line we broke and we held it there. I mean, I can show you really quickly. I mean, this is what's annoying when the market moves sideways is you basically end up with like way too many lines on your chart. See, we basically ripped through that trend line and then we came down and held. This was a Friday, and you can see that this was that last level was the high on a Friday, which was the weekly high. That's the thing that grabbed my attention about it. You can basically see here that it went down and held that. Now, we were also looking at this level back on November 29th, which you can see this level right around 60.32, which was a close on on this year on the 29th. You can see how that was support until basically the Fed was hawkish there. That was when the Fed came out and cut the plots. And there we are. We get back above it, and look at how we've basically stayed above it. The 60-32 level, I mean, there's just too many levels on the chart. But basically, if you do look here, I mean, the 60-32 level was also important, and we've also held it. So there's just a lot of things here that are, I need to draw it really quick. You can just see that 60-32. We've had, even with these drops, if you actually look, we've had very few closes below that level, really this month. If you go here to the actual month of February, you can see we closed below it on February 3rd, and then we basically just nudged below it back on Friday, and now we're back above it. So breaking that level and this other weak level, a lot of levels, but the fact is all of them seem to be building support at higher levels as we inch toward the highs. So the American Association of Individual Investors today, I think it was 53%. I have it on my other screen. I'm going to look very quickly. 53% bearish. Let me see. I have it over here. The bullish was 28%. It was the second lowest bullish reading since November of 2023. The bearish was 47%, I'm sorry, which was the highest since November 2nd, 2023. Now, of course, we keep going back to November 2023 because that is when the world came to believe that inflation was essentially over and the Fed was moving to cuts. You can go back and see those old videos on YouTube if you want. We did them. There was a lot of interesting stuff happening. And so basically, just realize that that was a period of peak negativity. So here we are with peak negativity, with the market hitting highs. Now, there is something else that is, well, actually, there's two other things that are happening that are very interesting. First of all, FactSet, that it's worth reading the earnings insight every Friday. Basically, we are now looking at 16% earnings growth in the fourth quarter that is now mostly being reported. That is way up from where it was at the end of last year. Analysts was looking for Wall Street was consensus at 11.8, and now we're at 16.4. Now, what's interesting is the current quarter, Q1 of 2025, which will be reported starting in April, that number has come down pretty significantly, about 3 percentage points. However, it's because of all this uncertainty. So now you have management saying, oh, tariffs are going to be so bad, we have to cut guidance. And think about it. If you're a management, if you're a CEO, why on earth would you basically be guiding aggressively here? It makes way more sense to say, oh, tariffs are going to be a real problem. Why? Because I mean, if you get to basically define your own goals, you want to set a low bar. Executives have been doing this for a long time. It makes sense for multiple reasons. And that's actually something to think about. Again, the thing is, what does that mean? It's a wall of worry. That is what they're doing. They're setting low expectations that they can then pass. They're saying it's going to be terrible. Then what happens when it's not? Again, I think it's important to realize this dynamic of the wall of worry is happening. The third point is that the consumer sentiment last week showed extreme negativity. People are terrified about tariffs and inflation. And the thing about consumer sentiment is, I mean, it has been historically not accurate. It has been so negative, really, ever since COVID. However, they do the survey at University of Michigan. I don't know what it is, but it has not given. I mean, we did it last summer. We did on this webinar, we talked about how consumer sentiment was comparable to where it was in 1982, when like inflation and unemployment were like way higher. You can go back, I think it was August of last summer. We did this on market trends. So the key point is that everything here has this massive negativity. So I would just say, when you combine right now what is happening with if you combine what is happening with the fear, if you combine what is happening with the negativity, and the earnings growth that is real and happening, I would say that we are in a very special and asymmetrical moment. This is not normal to have this kind of negativity combined with this kind of fundamental strength. And I think these things come together, and I think we just have to realize that this is not really a normal environment. And let's just kind of bear that in mind. And maybe that's the reason why we gap down, and then 5 minutes later we made our low, like I said, on this gap down and on this gap down. And this one was like, I don't know, it was down for like maybe 60 to 90 minutes on the open. And then by 11 o'clock Eastern, it was well off the lows. So again, this was DeepSeek, this was the tariffs, and this was hot CPI. That's what those numbers were. So now what is also interesting is there was an article, and well, first of all right, let's go here and look at the actual, at my blog post. hopefully I'm going to have time to get some options activity because there are some interesting things here. All right, we cover a lot of these things, but it's interesting. We talk about this thing happening now potentially with Putin and Russia and all, and Ukraine and all that stuff. And I think it's also interesting here that you know, it's interesting. I mean, this Chinese thing. I think now David Tepper has been saying this, and there is signs here of this Chinese thing widening. Now we've talked about it. We talked about the potential for this, and we things like Alibaba and stuff that have performed. Baidu hadn't performed the way we had kind of discussed it some in a previous webinar, but there's interesting news on it. Well, I'm actually sure what the news is today, but it is actually ripping today, and it might be a name that people actually are looking for, which is Baidu, Bidu. Some of these companies also report earnings next week. But what's interesting here is let's look at some of these things. Crude oil inventories higher than expected for the last 3 weeks. Okay, that's interesting. If the Ukraine thing gets resolved, that is also going to be something that is not necessarily going to be pushing oil prices higher. If there's things like Russian oil coming back to Europe and all that kind of stuff, all those things are potentially negative for energy prices. And negative for energy prices also is a negative for inflation, but a positive in terms of what investors want. But the thing is that that's another thing that's out there now where this is way you can say, oh, it's like the 70s, but it really isn't, because right now, we don't actually see the oil crisis or anything like that. None of these things are going to necessarily cause oil. So what's interesting is there was another article that came out. So this is from the EIA, which is the U.S. government. 3 weeks in a row, we've seen inventories rising more than expected. Another interesting note today came out from the IEA, which is the UN thing. The IEA is the International Energy Agency, and they basically are saying, there's an article on Reuters and Bloomberg about it, they're basically saying we have unprecedented slowdown in Chinese fuel use. So the thing is, China's economy is struggling in various ways because of their bad loans and all of that. But there's also and that's cyclical, but there's also a secular issue, which is basically they've been building all these electric cars, they've been building all kinds of public transport and all those things, and now we're actually at a spot where China's economy is using less energy. So I think that is just overall. So it's both a cyclical thing from the economic struggles from the banks, and then it's a secular thing from the rise of these cars and all this electric stuff. So this is a big thing. I think when we actually take a look at it, you take a step back, you realize, yes, OPEC is increasing production. Yes, Trump is probably going to allow more American production. And the Ukraine thing potentially, I mean, if there is any kind of sign of thaw and maybe fewer sanctions or anything like that, oil could be a place that people look to hit. So we actually did a trading view idea. If you go up here, if you click on this, we basically say our trading view. Wait, here. So sometimes this link is not. It's not super visible, but the word here is actually a link. So we actually did an idea here about the XLE, and we actually mentioned on State of the Market that energy might be able to kind of bounce and hold and stuff like that. We just said that like our big mostly negative view of it had somewhat faded. But I think the thing is when we see this other information and we also see what's happening with the likelihood of the Russia thing and the Ukraine thing, this is a big story. You put that together, and then you also see. Let me just look at XLE. I want to just say that this is now setting up as a potential kind of bearish flag here, where it's coming off the lows today, but this is something here where if this remains in a situation with lower weekly highs, and we get some kind of resolution to this situation, this could be something where if it does break, I mean, this could actually be something that has, some risk. So I want to just mention that this could be something here where repeatedly energy has been something that we have been able to identify kind of bearish setups. And I want to just mention that this is something here that's setting up. I mean, it's not really confirmed yet, but it is in a spot where, it might inch back up toward 90 here. But I think we look at this overall and, this might be something people kind of, see some potential in. So I want to just kind of put that out there. All right. Now, I also thought it was interesting that if we look here and you actually dig into, well, we mentioned these things about the German DAX breaking out. All right. I want to mention the inflation. There's some interesting stuff. So yesterday, the CPI was hot. But if you actually dig into it, food away from home, which is basically fast food, was the slowest increase year over year since June 2022. Now, for me, I know that groceries and stuff have been an issue, but food away from home it's almost as big of a piece in the index. I think groceries is about 8% of the CPI, and this is about 5.7. But what's interesting is that it continues to slow, and that is in some ways, you know, a measure of inflation as well. So I think it's kind of interesting to see that. Now, owner's equivalent rent basically had the slowest increase. It has been in a steady downtrend. If you look just at they put out multiple press releases on the BLS website. The first one just says shelter, but then if you dig in, you'll actually see that shelter includes hotel rates, and that has been high. But the thing is, if you don't look at that and you look at owner's equivalent rent or rent, those numbers are slowing sharply, and that is really the big enchilada. That's the owner's equivalent rent is 26% of CPI. So we've often said it's like 36% of CPI shelter. So 26% is owner's equivalent rent. Like another 5% or so is normal rent, which is, I guess, tenants. And then the other is hotels. So just so you know, these numbers are not the same. When we've said 36% shelter, it actually has three subcomponents inside of it. And owner's equivalent rent is the most important. And this continues to slow. So if that structural slowing of owner's equivalent rent continues, this hot inflation might not really follow through. It's also interesting to see that medical services kind of have started inching lower as well. And that I just want to focus on that. We saw a big spike in used car prices, but for the most part, those have been moderating. New car prices actually fell. And so there are things here that I just want to point out when you dig into that report, the important ongoing structural things that really drive inflation are actually not doing that terribly. And that's mostly things like owner's equivalent rent. Um, and I mean, things like food away from home and things like that. Those are the things in some ways people see. The grocery stuff, I don't fully understand. I just want to mention the inflation report, despite looking ugly on the surface, was not that bad. Today, PPI was also higher than expected. But there was a note from Citigroup that basically, and I don't fully understand this. I didn't really dig into the numbers, but it was an article on CNBC that quoted the economist at Citi. So, that's what it is. I don't understand exactly the level of analysis they did, but what they said was that basically if you dig into the internals of the CPI and the PPI, that the actual knock-on effect for PCE is actually not as bad as you would think. So it's just kind of interesting. They actually said that it could show a slowing month over month from 0.45 to 0.22. So remember, PCE is the last one that comes out. It comes out with the personal income and personal spending at the end, almost the end of the month. But it's the one the Fed looks at the most. The market normally doesn't react to it as much because we've normally had CPI come through first and really kind of give us the emotional hit. But the key thing is that it's an interesting note Citi put out. They basically said that the internals are actually not as bad as you would think looking at the hot CPI overall. So those are just some interesting things I thought were kind of interesting. All right. Now the euro is right back near where it was. So again, people expected this and they just smashed it, and that's kind of it. All right, now I gotta just mention, if you look at this article here, we talk about things like CVS, Coca-Cola, McDonald's. Then Cantor Fitzgerald puts out a note saying the Mag 7 are vulnerable to people selling them. So what are we seeing? Let's actually look at some things here on our empty breadth. This is one of the workspaces. If you go actually and you go up here to the top and you get the downloads and you get the zip file and you import the ELD documents, which then gives you all the indicators, and then you open the workspace that is included in the zip file, you see MT Main October 2024. We haven't made any changes to it, so I don't want to update it until there's something new to change, because sometimes people have different updated versions of TradeStation and updates on different periods. So I'm trying to keep it with an older version of TradeStation just by a little bit so no one has issues. Sometimes if I update my TradeStation and then sometimes maybe not all the customers have had their platform update and then it might not work. So I just want to tell you why I'm still using the October. Anyway, what is interesting here is all right, look at the breadth, MT breadth. This is the NASDAQ, the Qs. Look at this is the number of new 52-week highs. So right now, in the NASDAQ 100, we have 14 companies making new 52-week highs, which is the most since back here on December 6th. So that's just kind of interesting. So this is what we said about the companies. So who are those companies? Let's go over here back to MT Main, and let's look here at our let's go to price grid. Sorry. I got to hide myself so you can see my platform. But we can just go now here to data, at symbol list, NASDAQ 100. And we can then look through and just see some of these companies. So I'm going to just quickly go through and just mention some of these. Another trading view idea we did today was on Vertex Pharmaceuticals. You might want to check this out. This company has apparently, and I would say that this is something that is on people's minds. Basically, VRTX has a non-opioid painkiller that is obviously something a lot of people are interested in these days. And there's a stock that basically it dropped on a different piece of data, then it rallied on that drug thing on the approval. It was an approval of a drug. Then it basically had earnings that were just kind of middle of the road, and it pulled back. But here, look at this level here. This level from back here on October 7th, basically around 448 on VRTX, 448, and it's potentially holding the support levels. That's something that's kind of interesting. Intel has been ripping. I said you look back over to NASDAQ 100, and we can actually see here if we actually look at who are the companies making new 52-week highs today. Well, oh wow, AppLovin. I didn't even know that. It's interesting. Cisco, CrowdStrike. Now remember, we did a blog post not that long ago. We were talking about the movement away from the mega caps toward other companies. CrowdStrike was one of those. So was Cognizant Technology that we actually had in that blog post. That was a blog post we did last week. If you look on, you got to just dig in and it's on the. I think it's here. If you maybe click on this. We did this other one that has like a digital bull on it. This one here, we did it back on the 4th, but we identified 6 companies that were kind of like potentially doing interesting things that seemed to be kind of absorbing capital from the big mega caps. Anyway, I want to just rip through these. I can't believe I only have 3 minutes left. So let me very quickly go through these names. I want to just very quickly mention Intel. Apparently there's going to be a spinoff. There's this idea that Intel is going to be favored by the new administration and onshoring and all that stuff. I think the thing to remember is that Trump was very favorable toward Intel in this first administration. Now, guessing on geopolitics and stuff is just like not what we do. But the overall thing is that here's a name that also we are seeing a trend. We are seeing some of these names come off lows as the big names kind of stall. So Coca-Cola, for example, this was a very interesting fundamental story. Remember, we have our 7 catalysts for stock movement. You can find it on the blog, but they basically had unit volume growth, which means that basically existing customers are buying more of their soda. They're mostly doing it in emerging markets, but the thing is that if what they're doing is apparently they're somehow tinkering with sizes to basically drive growth. And the key thing is they're finding ways to make people buy stuff despite inflation. And when people manage their products well, it can result in unit growth. It can result in higher margins. That's what we saw Netflix do. It basically reinvented its business. Remember, business transformation, changing products, things that boost margins, that is often a real catalyst, especially for something like a consumer staple stock, which basically always has a certain flow of business. And if they can just make that like business they do a little bit more profitable, you can end up with significant margin impact. This thing in Coca-Cola is very interesting. I don't have time to dig into the options chain, but I would just say this thing trades a lot of options. This could be something where people actually look for a return up to these levels. Something maybe like, I would almost say like a calendar spread up at like 72, where basically a person buys longer dated, sells shorter dated, both at 72, and then basically every like week or so, as those short dated calls expire, then you sell more. And then the idea is that as time moves on, you're bringing in income that then reduces the overall cost basis. And then if the stock does reach the level, then you start selling calls higher out of the money. And this is a calendar spread. We talked about it with Wells Fargo before, but that was all right. That is Coca-Cola. AstraZeneca, these are just companies, but they had a bunch of interesting, they had some kind of strong earnings and an upgrade today. Again, these are companies that there seems to be a trend of people shifting away from the mega caps to other stuff. These are real companies. These are not like random things. And that's what the market is doing this year. This is what people have been saying is going to happen, and it seems to be happening. So I want to mention this one. Vertex, we talked about. Crocs also had a potential CRO. X had some kind of potential turnaround. The stock has really taken a beating, but this might be one people want to look into more and learn a little bit more about it. I would also mention that Baidu has an AI initiative, and they report earnings next week. So for me, this is one where people might want to be thinking about a call spread targeting the expiration of next week, which is what the next week is the 21st. So doing the February 21st expiration, we have earnings, and then you have the AI catalyst. This might be one that I think people want to kind of pay attention to. Also, Reddit had a bad report. And from my perspective, this might be one where people kind of look for a move down toward like 182. I want to just say, if you want to put it on your radar, 50-day moving average down to the bottom of the Keltner channel. Want to just kind of point that one out. And Freeport McMoran, FCX, copper has been performing. If the dollar weakens, look at HG, which is copper futures. They've been kind of coming off these lows here. Freeport, I want to point this out, has this falling trend line. This one trades a lot of options as well. So I don't have time to get into the options chain, but this is also one where if you actually look, this is one that is now potentially breaking a downtrend. And so, you can kind of see that. I mean, again, this fits into the global theme. It fits into the weaker dollar theme. Also, the last thing I'll mention here, we go back over to MT Main. We go to key ETFs. Let me hide myself. And then basically what we can see here is that if we actually look at the spider funds today, materials are doing pretty well. So it's kind of interesting to see that corresponds to a weak dollar. So things like financials kind of struggling, things like industrials kind of struggling. They have high valuations. They have uncertainty. The things that are cyclical American are kind of weak. Another one like that are the airlines. They're just struggling and drifting here. They've had this really sharp run. A lot of these stocks, if you look at them on the weekly chart, look at American Airlines here. You can basically say on the weekly chart, these things have had huge moves, things like UAL. This is the weekly chart. So, these things have had big moves, and people might look for these to consolidate for a long time. So I want to just kind of point that out. But then something like materials, back on State of the Market, we had basically talked about a resistance level that we're basically taking out. Like today, we had talked about this right around here. Go back and watch State of the Market. We talked about it, but today could actually be some confirmation of that. So I got to go. We will see you guys. Monday is President's Day, so don't forget that. We'll see you next Thursday for market trends. Hope everyone has a great day and great weekend. I'll see you next week.